NVIDIA. Listed on NASDAQ since 1999, today, a $4.9 trillion company. Fiscal 2026 closed with $215.9 billion of revenue, up 65%, and $120 billion of net income, more profit in 1 year than any company has ever reported. 3 things the numbers say. First, compounding at hyperscale, revenue tripled in 2 years at a 71% gross margin. Second, this is a cash machine, not a capex furnace. $96.7 billion of free cash flow on just $6 billion of capex. Third, the balance sheet is a war chest, $85 billion of cash and investments, and $40 billion returned through buybacks. The plan runs on 6 actions: hold the annual architecture cadence, win the sovereign AI buildouts, sell the whole rack, not just the chip, deepen the software moat, secure supply years ahead, and navigate export controls by design. The roadmap takes revenue from $393 billion next year toward $850 billion by fiscal 31. The strengths are structural: 2 decades of developer lock-in, and a 67% EBITDA margin at scale. The weaknesses are concentration: a handful of hyperscale customers, and 1 leading-edge foundry. The opportunities: sovereign AI and the inference era. The threats: export controls, and custom silicon inside the biggest accounts. 5 forces, 1 conclusion. New entrants face a wall of software. Supplier power is the real pressure point. Leading-edge capacity and high-bandwidth memory are scarce. Buyers are few and powerful, and they are building their own chips. The rivalry that matters is moving from training to inference economics, where the platform, not the part, wins. The business model: architect the silicon, build fables, sell integrated systems, and monetize the stack in software. Data center is roughly 88% of revenue. Gaming remains the original franchise. Robotics and automotive ride the same platform optionality at near zero marginal R&D. Operationally, 42,000 people producing over $5 million of revenue each, engineering density no manufacturer can match. Technology runs on an annual architecture rhythm. Supply is secured with prepaid capacity. 21 billion of inventory is a weapon here, not a warning. And the software layer ships as enterprise AI services. 5 risks, owned and gated. Custom silicon substitution, high and high, answered with cadence and software depth. Export controls, the legal team's war. Supply concentration, hedged with prepayment and dual sourcing. A capex digestion cycle, cushioned by $85 billion of liquidity. And customer concentration, diluted by sovereigns, enterprises, and robotics. Governance: founder-led for 33 years, with an independent board, a clean audit history, and controls attested since 2004. The next print lands August 26. Capital returns are real: $40 billion of buybacks in fiscal 26 alone. Context: rates at 4.5% still punish long-duration stories, but AI capex spends through it, because the budgets are strategic, not cyclical. Hyperscalers, enterprises, and now nation-states are all building. Supply: advanced packaging and memory is the industry's true clock speed, and the reason demand converts on NVIDIA's schedule. The portfolio, drawn to scale: rack-level AI systems, GeForce for gaming and the AI PC, DGX Cloud, enterprise software and inference microservices, Jetson for robotics, Drive for vehicles, Omniverse for industrial twins, and the networking fabric that ties every rack together. Everything plugs into one platform. The core, close up. 88% of fiscal 26 revenue is data center, $190 billion, up from 78% 2 years ago. Blackwell rack systems carry the mix, inference demand compounds on the installed base, and sovereign programs broaden the order book beyond the hyperscalers. Peer comparison, at live market caps. NVIDIA, $4.9 trillion. Then Taiwan Semiconductor at 2.1, and Broadcom at 1.8. Micron, AMD, Intel, and Qualcomm follow. NVIDIA is 1.3 times Taiwan Semiconductor and Broadcom combined, and nearly the size of all 6 together. Valuation: risk-free at 4.45, equity premium 4.33, beta 2.2, the discount rate lands at 14%. On the 5-year plan, discounted cash flow returns $120.60 per share against a market price of $202.81. Read the note before reacting. The model prices the plan, the market is pricing the decade beyond it. No buy, no sell, no hold ever. Stress the dials. Across the discount rate and terminal growth grid, value runs $101 to $149. The tornado says the discount rate matters most, then margin, then growth. Bear case, 85. Base, 121. Bull, 159. The story survives every sell, the entry price is the debate. Catalysts on the clock. August 26, the first half-year read on Blackwell Ultra. Sovereign contract announcements through the second half. The next architecture at GTC, export rule updates either way. And the steady drumbeat of buybacks against nearly $100 billion of free cash flow. The dashboard, 3 audited years, 5 planned. Revenue from $61 billion to a planned $852. The EBITDA margin holds above 60 throughout. Earnings per share from $1.19 to a planned $20. Free cash flow follows earnings almost dollar for dollar, that is the signature of a fables model. One chart tells the story, revenue tripled, and the margin line never left the 60s. From $61 billion to $216 in 2 years, and the plan carries it toward $852, while EBITDA stays above 61%. Scale without diluting quality. That is the rarest pattern in corporate history. The result bridge, audited. $215.9 billion of revenue. $62.5 billion of cost. $18.5 billion of R&D, the cadence engine. 4.6 of overhead. $11 billion back from interest and other income. 21.4 of tax. Net income, $120.1 billion. The transformation map. 1993, a graphics startup. 1999, the IPO, and the word GPU. 2006, CUDA, the accidental AI platform. 2023, the ChatGPT moment. 2026, the AI factory decade, priced at $4.9 trillion. 9 dials behind the budget. A consensus-anchored revenue glide from +82 to +10. Data center holding near 90% of mix. Gross margin near 70. R&D sustained at 8.6% of revenue. The EBITDA margin easing to 61.5. CapEx near 3%. Tax at the reported 15.1. A 1% yearly share shrink. And a 14% discount rate. The scorecard wires the plan to owners. Financial, revenue, margin, and free cash flow, quarterly. Customer, data center share and sovereign wins. Process, the annual cadence held, and supply coverage ahead of demand. Learning, R&D intensity and software attach. Every target has a cadence and a name. The 5-year table. Revenue, $393, $561, $687, $774, $852. Earnings per share, $8.99 to $20. Free cash flow, $175 rising to $410 billion. That is the table the board signs, consensus anchored, margin honest. The master budget phases fiscal 28 month by month, deployment cadence is broadly level, quarter ends lift on systems acceptance, and January closes the year on the strongest exit rate. $561 billion, weights summing to 100.0. Last page. Quarterly phasing steps from $126 to $153 billion. Of each planned dollar, 30 cents cost, 9 cents R&D, and 47 cents of net margin. Cumulative free cash flow across the plan, $1.5 trillion. Produced on CFO and Business. Explore the full platform at coin.com, that is, CFOINB.